Good evening, everyone. Welcome to our exclusive webinar. I'm Ashna, and I'm thrilled to have you all with us today. Today's session is all about Alpha Insights, where we'll be taking a closer look at how it's been performing, what's changed over the past 2 months, and most importantly, we'll be addressing any questions you might have with the help of our esteemed panel. I'm delighted to introduce our speakers to you today. We have with us Ms. Archana Ravichandran, Head of Investment Products at Investor AI, with over 9 years of experience in investment banking. Mr. Rajesh Ravikanti, Chief Operating Officer at Investor AI, bringing 18 plus years of expertise across strategy, operations, technology, and client servicing. And we have Mr. Lakshit Maheshwari with us, Project Manager at Investor AI, an expert in investment products with over 6 years of experience in institutional trading and product development. So before we dive into the presentation, I'd like to extend a special thanks to PL for giving us this opportunity and for organizing today's webinar. With that, let's get started. Archana, over to you.
Hey, Ashna, thank you so much. Hi, everyone. Thank you for joining us. Again, I'd like to extend another welcome apart from the one that Ashna gave you. So today, actually, from our side, we have a few panelists. So I will just hold on. Okay, so you have myself and Lakshit. We also have Rajesh, whom many of you might be familiar with and have spoken to in the past, and Ashna joining us as well. So we'll start with maybe just a little bit of an insight into the way that the markets have performed in the last month and how we are doing in tandem with the market. So overall, the market outlook for this month, especially since Trump's announcement of Trump's taking over the presidency as well as announcement of tariffs, etc., has been quite volatile. That said, we do see that the market volatility across, the global markets is much higher than Indian markets. In tandem with that, we also see that while across, different markets in the world, we see negative performance, and quite along with the volatility, we do see some positive performance on the Indian market side. So the outlook for the Indian market in the coming few months does look positive, but we do expect that volatilities will continue. That said, so I'll just run through a short note on what we have as an offering on Alpha Insights. So this is an AI recommended basket of 16 stocks, which pick stocks across different strategies, momentum, value, as well as sector. And we have insight generations on 3 days of every week, so that any new customer that joins us, will be able to get a portfolio recommendation on the immediate following day. And that with that, each portfolio rebalances every 2 weeks. The last 12-month returns across our baskets. So I picked one of the variants as a display here. It's at 16%, as opposed to Nifty, which is at 7.1%. So this is also a view of the average performance across variants. We do see quite a lot of volatility in, in the average performance, and a lot of deviation between different variants on the basis of when there was an entry in the market and over the course of, so as you may all know, we have about 40 variants that are currently running, and so across the variants, we do have quite a wide range of performance. So if we look at the averages, we stand at 13% on the cumulative front from inception to date. Our 12-month return stands at 5%, 5.1% as against Nifty, which is at 6.3. And in the 6-month and 3-month periods, we, along with the markets, our portfolios also took a negative turn. And in the last 1 month, we've again taken a positive turn. This 6 and 3-month, negative performance, like I just mentioned, the negative performance in the overall markets impacted our portfolios extremely heavily. Along with that, we also began to heavily scrutinize the way that our model is throwing out recommendations and our underperformance against Nifty 500. So we had a few short-term as well as long-term changes that were proposed so as to combat this negative performance. And on the short term, one of the things that we did was we noticed that some of our variants were performing worse than the others. So we moved investors that were in these variants to other variants that were performing well. And over the long term, we also went back and took a deeper look at our models, retrained them, and released new models. The new model release happened towards the end of March, and since then, along with the release of the models, we also saw a slight turn in the way that the market is functioning. From we're just seeing it, switch over from the bear to the bull. And with that, we also see, that our performance is also improved in the short period. So this is just a little overview on the things that we did so as to support the performance of our models. So the turn of performance happened between November and March, November 2024 to March of 2025. We saw multiple variants drop in performance, but our scrutiny indicated that some of our variants were performing worse than the others. And we began to discuss internally on what kind of things we can implement so as to limit losses. So the short-term fix that I was mentioning earlier was implemented in Jan 2025, where the users that were receiving the worst hits were moved to better performing variants. So 16 users from 16 different variants were moved. So we originally, while we had 40 variants on the market, that dropped to 24 variants. In the meanwhile, we also began to retrain our models. Why this was necessary is because while we have a 10-year training period for all of our models, it is very important for models to look at more recent data, because trends in the market continue to change very, very consistently. And we do see that in the recent periods, market trends switch more frequently. The way that different sectors behave in different kinds of climates in the market also tends to change. And so that was the first thing that we did, essentially, that we retrained all of our models. Along with that, we also had a few other changes that we made to the model, and I will come to those specifics a little bit later on. And that said, another key thing that we implemented when we went live with our new models in March was to limit our universe of securities from the Nifty 500 to just the top 300 by market cap, so as to reduce the allocation to small caps. This is also basically to further reduce the risk of underperformance for HNI clients. These models were released on the 28th of March. And since the change in strategy and this new model release, we've had 10 new users who entered into the Alpha Insights portfolio. All of them are making positive returns, and 8 of them have beat Nifty 500. So this is, if you look at the variants that are underperforming Nifty over the 6-month, 3-month, and 1-month period, you will see that 22 of our 24 variants underperformed Nifty in the 6-month period. That dropped to 20 of 24 variants in the 3-month period, and that in turn dropped to only 9 variants at the current stage, considering a 1-month period. This is a graph to indicate for you guys. So the first graph that you see on the top is the 1-month performance, and the second one is the 3-month performance. So if you look at these two in tandem, you will see that those variants that actually underperform the most during the 3-month period, these are the ones that are actually at the moment struggling to beat the Nifty 500, as opposed to the ones that underperform the least. For instance, if you look at variant number 7, in our 3-month period, it underperformed Nifty only by 2.2%. It was only a negative 2.2% as opposed to Nifty, which is minus 0.6%. And if you look at the same variant on the top, you'll see that it's outperformed the Nifty. And similarly, if you look at the variant 1, which was at 0% returns in the 3-month period, you'll see that we've outperformed Nifty by quite a wide margin. I'll move over also to the next slide, which shows the recovery period, which was, so we saw that all of our portfolios hit, the worst performance during the period of the end of Feb to the 13th of March. So if we look at our performance or the pickup in performance from 13th of March, you'll see that out of the 24 variants, there are only 2 variants that are lagging the benchmark, and all the other variants have beat benchmark during this period. So as promised, some of an overview of what changes we made to the models over the last few months before we released in March. So the first thing is that we retrained all the models. Like I said, they've been updated with all of the latest market data, and this includes the 6-month deep bear period that we had in our market, which was extremely recent. So this helps our model to learn a little bit more about how market cycles are changing over time, as well as pick up more recent information and learn from that. Along with that, 3 other extremely important changes that we've made. One is to expand our data set. So the depth of data has been increased from 33 to 60 fields across all the different types of attributes that we have. We've also added some US ETFs so that the models can understand global market trends in tandem to Indian market trends. Along with this, within the Indian market, we've also added some proxies for commodities, emerging markets, metals, etc. All this put together, our learning base increased by a solid 3.7x. With that, we also made an upgrade to our engine. This is important strictly from a model perspective, so as to just reduce false positives from the model that the model might be throwing out. And then the last change that we made was to optimize our the way that we do stock selection. So the new model, this also learns a little bit from, we've introduced VIX and other global market indices to the new model, so that it learns a little bit more and penalizes the model for the cases where it throws out incorrect recommendations, so that we weigh stock selection as best as possible. So I'll move over to the next slide, which talks about a few of the common queries that we've received across the board, as well as from many of you at PL. The first one being, why do we see a difference in returns between what we publish in terms of model returns and what the end user might see? The first reason that this happens is because of slippage. So while we generate our model returns, what we usually do is we pick up returns as of previous day, like our base is the previous day's close, because that is the point at which the model is throwing out recommendations, and that is weighed against current market price. And this is as opposed to trade execution time that actually happens for any particular user. This is all the more important in cases where user might enter the market not only on the day that we send out recommendation, but a few days later. This also might deeply impact the way that their portfolio performs. The second reason that we've seen impact this particular query is that the user might be also executing trades outside of whatever we are recommending at Alpha Insights. And this can also include, for instance, a larger portfolio that they might be maintaining with PL. It might be the case that they are choosing to execute trades only with part of the portfolio that we recommended Alpha Insights, and so on. So all of these things also contribute to deviation with a model return that we may publish. The third one is, again, trading outside of recommendations. So this is, it ties into the second point. So anything that is traded outside of the recommendations, this is something that we don't consider, and so will deviate in terms of returns. And the last is brokerage. This is something that we don't factor into the returns that we calculate in our model. And depending on what the investor may be paying as brokerage, that will also in turn impact their return. The second question that we've received a lot from various partners is why we do not recommend this stop loss. So the reason that we do this is because our model has been backtested multiple times. Each time we do our backtesting, it tends to prove that it shows consistently positive returns over long runs. And the second bit is that as a model, we do throw out recommendations for a 2-week period of time, and we believe that any negative return will be recovered within that period of time. So as long as an investor continues to stay invested and stays invested through that exact period that we are trying to recommend for the 2-week period, that we believe that they will continue to make positive returns. Why churn within the same stock? This is also another question that we receive a lot. Users may see that they might have a particular stock in their portfolio recommended about 3 weeks ago, and then or 3 rebalances ago, and then that stock is re-entering into the recommendations at this point. The reason that this happens is, again, this is highly dependent upon the model. Each of the models that we have, the momentum, the value, the sector model, each of them have a certain set of conditions on which it has trained and optimized. And while you see a particular stock may have entered from the momentum category about a few weeks ago, it may enter from a different category at this point. It is also possible that a stock might enter in a momentum category about a few weeks ago and then re-enter again at this point. And this is also largely dependent upon the way that the price series of that stock has performed. So if the model sees a breakout pattern or believes that it's seeing a breakout pattern with a particular stock, it will continue to recommend that. But however, on the other hand, if it sees that the stock has crossed a particular range because of which it believes that we do not have any more possible upside in that particular stock, then it will choose to ask you to sell it. The next question is why we don't create cash when markets are falling. This is again tied into the other two questions. We have a strong philosophy that each of our models do generate returns over the expected periods. So for instance, if we have our momentum model does, the trend does, it's expected to last 2 weeks, and it does generate returns over the 2-week period. And similarly, for our value model and for our sector model, we expect that it will generate returns within the periods that we are predicting for. That said, markets do tend to rise and fall. We want to capture all the upsides in the market despite downturns in the market. So when we do see that there's a turn in the market in the negative side, then we want to also simultaneously try and sell and limit loss. And this is also predicted entirely by the model. The last question that especially we received relatively recently is how we plan to limit our drawdowns. This is linked to one of the changes that we've made in the recent past, which is to restrict our universe. So by restricting our universe, we believe that the stocks with larger market cap, which are more heavily traded in the market, these are the stocks that will tend to lose less in highly volatile periods. And this is the reason that we have restricted our strategy. Along with this, we have also actually our latest model, especially on the momentum side, which tends to lose a lot sometimes. On this side, we have picked a model which actually predicts overall low drawdowns across the board. So this is also one of the things that we have done. So this slide kind of talks about how we as Alpha Insights stack up against competitors, including any PMSs as well as other small cases on the market. And at this point, I want to also highlight that over the 3-month and 6-month period, across the board, PMSs, small cases, mutual funds, all of these have lost heavily. So if we look at some of the most popular PMSs, they've lost much higher than Nifty, and at par with whatever we have lost at Alpha Insights. That said, on the upside, we do, we expect that over the next few weeks, we will see a much higher positive return given the new model implementation. So stacking up, especially against other small cases, we do see that we've performed better. But as opposed to PMSs, we are lagging in performance, but we expect to see a good improvement in the coming weeks. So we want to also reiterate at this stage that the best way to get value out of our product is to first take a long-term view and remember that markets will continue to go up and down. And as a strategy, we have proven that over long terms we can generate positive, upside over any benchmark. So to always take a long-term view and not panic in the short term when we have negative markets. The second is to rebalance regularly and follow the rebalance cycle. Rebalance on time, rebalance regularly, and stick to the recommendations that we're providing you from the model standpoint. The last is, of course, please remember that value will go up and down, and that do not panic sell. I'll move over to Q&A. So any questions?
Yes, thank you. Thank you so much, Archana. Like you said, we now open the floor for questions and answers. If you have any questions, please feel free to drop them in the chat box, and I'll be reading them out to our panel. Yeah, I think we have a raised hand. Could you raise your hand again, please, so that I can unmute you?
Priyanka raised her hand.
Priyanka, if that was you, could you raise your hand once again? Okay, I think we do have a question, and the question is open to all three of you. The question says, hi, to cover recent shortfall, how long a time it takes to meet the capital?
So I would say that so we do see that the market is turning now, and we see that while there is volatility in the market, there is still positive outlook towards the Indian market. This depends a little bit on how much as a portfolio you have lost over the last 6 months, like I mentioned earlier. So if you are in a position where you've lost significantly and you haven't beaten the Nifty as yet in this recent 1 month upturn, we would recommend you stay invested at least for the next few months, and we do believe that you will see very positive returns.
I hope, Prem, that answers your question. Please feel free to ask if there's any question in your mind. You can drop your questions in the chat box, or could just simply raise your hand and we'll unmute you. Okay, Prem Kumar, you've raised your. Just a second. Give me a minute, please. Prem, I'll unmute you, but in the meantime, I think we've got another question. This is from Mr. Bhavesh. What will be our stance before any major event like Union Budget, Trump Tariff Day announcements? How do you see we beating them?
Okay, I'll take that up. Okay, so all these events, one thing that are common, in these events will be volatility. So volatility is here to stay. For that, already the implementation that we have done is that we have restricted our universe. So that will weather us from volatility. And also what happens to manage Trump tariff day announcements, that will be, ongoing trade negotiations and what is to come in next few months. We have incorporated tracking of macro events, which using US ETFs, sector ETFs, commodity ETFs, and the various trends on macros. So when we expanded our data set from 33 to 60 fields, we added all these things as to understand global cues based on geopolitical, uh, either geopolitical tensions or what is going on around global trade. So yeah, so these two things as of now, whatever we have done in models should take care of them. Yeah. But if you are talking about any discretionary call based on union budget, since it is a systematic strategy, that we won't be doing that.
I hope, Prem, you got your answer. If you have any more questions, please do let us know. I think we'll have the session on for another 5 to 10 minutes. So if there are any questions or any thought or anything that you would want to share with us, we can pick that up. Okay, so I think we have a follow-up, Archana and Lakshit, from Prem. He says, ma'am, we have started the client since 1 year now. The subscription is ending in the next 2 months to 3 months, and the client is still under loss. So is there something about extension?
Let me take that up. So, Prem, I think we have taken a case by case basis, and there have been instances where we have extended the subscription by 3 months. This particular customer, if you can provide a client ID or something, we can take based on when the particular person has subscribed. I think we can extend it by about 3 months.
I feel if we don't have any more questions, we can conclude the session. Archana, any parting note, anything?
Yeah, so I just want to call out to everyone that I think over the period of the last few months, we've had quite a rough bear market, and as much as you guys have felt pain from investors, we've felt it just as much across the board. So that said, I know that Rajesh has spoken to many of you, one-on-one in order to help you manage expectations with clients. That said, we're at the moment monitoring our portfolio extremely closely, and we also intend to do these webinars a little bit more frequently. So we expect to continue to support all of you, on any front that you expect support from us.
I think before we close the session, Prem, if you could really help us with the client ID. Okay, I think we have a addition. It says monthly basis review needed.
Absolutely, Pushparaj. Actually, we do a bi-weekly review along with PL. We monitor our performance actually weekly. Every week, every time we begin a week, we start with monitoring performance of clients that are on the PL account, and we also send out a little report to PL as well, so that we let them know, and we can take questions from any of you.
Okay, so thank you once again, Archana, Rajesh, Lakshit, for sharing such valuable insights today. And we really hope the session helped clarify the recent changes in Alpha Insights and gave all of you a clear picture of its performance and the changes that have happened in the last 2 months. I would also like to extend a special thanks to PL for their continued support and for organizing today's session. That's all from us this evening. Thank you for joining, and we look forward to connecting with you again really soon. Thank you, everybody.
Thank you.